Hi, everyone. It's Tim from Aussie Expat Home Loans, and I want to thank you again for joining us for our monthly property pulse, where we help you stay up to date with the latest stats and trends in Australian property with the best in the business. My guest this month is Brad Reece, the founder and CEO of CapitalVue. CapitalVue was started in 2023 with Brad and his two business partners, Andrew and Chris, and they have a single mission to equip investors with intelligent insights and reliable partners to help you unlock financial freedom through property investment. Brad's been personally investing in property since 2004. And over the years, he has honed a multitude of strategies, all aimed at helping investors grow their wealth and navigate the industry's challenges. He also has a background in technology, and part of CapitalVue's innovative approach is to help you manage your portfolio through an app and a suite of other services. Brad, I really want to thank you for being here today. Before we start, I thought it'd be really great to hear a little bit more about your story and some of the ethos of starting CapitalVue.
Yeah, definitely. Thanks, Tim. Excited to be here. I'm looking forward to our conversation this afternoon. So we started CapitalVue, Tim, with there's probably 6 key pillars that fit into our ethos. We wanted to ensure that investors were empowered, which is the whole concept behind our app. One of the frustrations as property investors that my business partners and I had was we're tracking the performance of our properties in a spreadsheet. And each property had its own separate spreadsheet or tab, and unless you're an absolute Excel whiz, it was very difficult to aggregate the performance and have a quick snapshot of how the portfolio was performing. If you removed a property from that portfolio, how does it change the numbers? So that was the concept behind the app. We partnered with Reece, who provide us with our property valuation data. So our users have the ability to track their current valuations of their properties. As soon as they log into the system, they can update their vals, and they know exactly how their portfolios are performing at an aggregated view. They can pull out individual properties and have a look at have they got some stellar performers that are growing strong in capital growth, how the yields, what does the cash flow look like, etc. And we've centered the ethos of CapitalVue around those data-driven decisions. It's a tool that for us, when we are buying properties for our clients, we're able to utilize our own app to showcase potential investment opportunities and speak to the yields and really drill down into the operating expenses of that property, and then how that impacts on the net yield of that property. If they've got an existing portfolio, how that might marry up, and how it will impact the overall performance of the portfolios, etc. So we've found that that's been a cornerstone of what we do, and the early feedback has been really pleasing. Commentary has been it's probably too cheap, which is exactly where we've positioned it. We want it to be affordable for everyone. So for less than a couple of cups of coffee a month, you jump on the Pro plan. It's pretty cost competitive.
Definitely. I think I was having a play with it earlier as well, and I think it's especially if you've got 1, 2, 3, 4 properties. Exactly like you said, most people are tracking all of that in a spreadsheet. It's kind of in a way making the reporting as easy as if you had a share portfolio and just knowing your positions in different things, being able to work out actual returns on property, getting up-to-date information on things like value, especially. It's probably the one question my clients ask me is, can you do a property report for me from CoreLogic so I can see if I've made any money or not? So this is, just a much more active version of that. Which,
absolutely.
Especially around measuring return, I think they were really powerful tools that you've got in there as well.
Yeah, awesome. Thanks, Tim. That's great. Great live feedback. And obviously, then part of that sort of spills into our innovation piece. We use innovation and artificial intelligence in the background when we're sourcing properties. So all the data of the individual suburbs is aggregated, and we can actually pick the investment strategies for our clients based on their specific needs. If they're chasing growth, we can. We've got the higher growth suburbs, and we can, gives us some really good insights into historical trends, how the suburbs have performed historically, where we're likely to find those next growth opportunities.
Do you pull that data from places like CoreLogic, or do you have your own proprietary data? as well that you look at?
It is proprietary data, but there's multiple sources. It does pick up feeds from ABS. So some of the median house, median incomes, all those population and all the demographic data is sourced from that from that data house. So we've got some really good insights into how that suburb has performed historically. What does the growth look like? What is the median income? How does that compare against the state average? Is it above? Is it below? What is the demand like? What is the forecast looking like for for future population growth? So really important. And then probably the last three things are centered around integrity. I think we're all we've come from, with the exception of Andrew, who's had a really strong corporate career in real estate, where our backgrounds are not necessarily real estate. So we bring a fresh approach, very, very service-centered. And because we are investors, we know what some of our pain points have been through our own personal journeys. So to be able to share that with our clients and ensure that they don't encounter the same speed humps that we have perhaps over time and had to iron out. Sharing some of my personal experience with a couple of my properties have up until recently been extremely under rented, and property managers tend to not necessarily meet the market when they're increasing the rates, or they'll put a current market analysis from CoreLogic, which has got data which is 12 months old. So they don't have current data because property tenants are either staying in the properties and renewing leases, and as the market is going up, so they don't move the rent in accordance with where the market is. So, for us as a business, it's important to have that ongoing relationship beyond the purchase of the property. It's our clients can reach out and say, "Hey, could you please give us some recommendations?" Just to almost, in a sense, keep property managers honest in what the advice that they are giving their landlords. So, and as much as they should be transacting in a manner which is ethical and above board. I think when each property manager's got 200 to 300 properties under management, they are exceptionally busy, and there's a lot of on those sorts of numbers. There's almost one tenancy renewal per day, plus everything else that they have to deal with, maintenance, etc. So for them, it's a quick. They don't want to have to show houses, so their fear is often that the tenant's going to leave and they're going to have opens. And I've found that pushing my property managers to actually go to the market. I've not had a tenant leave as a result of the price increases yet. So
I think especially in the current market conditions,
absolutely.
anyone that's trying to rent, I guess in any city now, because obviously all the rental vacancy rates are just exceptionally low.
Yeah,
there's very few tenants that want to put themselves back into that market at the moment too. So
absolutely. Yeah.
And it's always a balance. Like, I find with a lot of conversations I have with clients, if they're good tenants, you feel like you don't want to push them too much. Or like for me, I've got a place in Zilmere in Brisbane, and it's got quite a big yard, and my tenants look after it very well, and I don't have to pay anything for maintenance. So it's kind of balancing between, I probably could push it a bit more, but at least I know the property is being looked after as well. But but it's also, at the end of the day, especially if it's an investment property and it's something that is not something you're ever going to live in, it's purely to help you build wealth and make money. There's got to be a balance between that as well.
Absolutely, yeah, it is, and it's finding that balance. It's in the current climate, it's the opportunity to capitalize on it, and it's if investors have mortgages on properties, their cost to hold has significantly increased from the low point of the sub 2% interest rates that we've had often most. And you would be closer to the stats of this, but most investors have come off their fixed terms, so their cost to hold is significantly higher. And that's also forcing their hand to an extent to increase rents.
For sure. And I guess there's a lot of people that I think we're seeing it a lot more in Melbourne at the moment. There are a lot of people that are putting underperforming investment properties on the market, and it's really down to cost versus opportunity, right? And it's just not, if you're not making money and you're not making much capital growth, it doesn't really make sense to hold on to properties like that. So
yeah, absolutely. And it depends on the investor strategy. We got a client at the moment who's who turned an owner-occupier in the Northern Territory into an investment, and the yield is exceptional on the property. However, it's actually backward from what they paid for it 8 years ago. And when you have an asset, people look at, oh, but it's generating me the money and taking this particular customer through the journey. But it's also impacting your serviceability because of the debt that's outstanding against that property. It's actually inhibiting your ability to buy another one. Whereas if you cut the loss on that, your serviceability goes up, which means the next property that you can buy, which is going to then be bought in trust, so you can continue to use your personal serviceability to grow your portfolio. It means that you've actually got more play and more scope to get a better performing asset. And given the poor performance from a capital growth perspective on this asset, it wouldn't be difficult to build and fund an asset which is actually going to really improve this client's wealth.
Definitely, yeah. I think it's a good lead into. I normally like to start with and around the grounds, but I guess talking about opportunities and trends, and I guess where you're seeing opportunity at the moment for good performing assets versus poorly performing assets. Where at the moment are you kind of narrowing in on? Is Brisbane still the hotspot at the moment for most investors?
Definitely. There's a lot of owner occupants in the market as well, and interstate buyers. A lot of the opens that I'm going to, and we're looking at blue chip suburbs. We are getting priced out of the market by owner occupiers. So there's a lot of people attaching emotional money to their purchasing decisions, which just and as an investment buyer, we need to make sure that there's a set of numbers and data points and metrics which need to stack up. And if they don't meet the brief, it is a hard no. We have to move on. So, which means that for our investors, it's a longer time in the wings waiting for the right property to come up, and sometimes we have to adjust the strategy. And it seems that in that sort of over a mil to 1.6, very, very competitive space, houses are selling within less than 10 days on market. So it's really important for buyers to have their finance in place, and we actually won't take a client on and engage them as a buyer until they have some pre-approval in place, whether it be through their own broker or bank, or if they don't have a connection, we'll obviously refer them to our partners. But really important that they have that finance approval, because often after viewing a property, because it is a seller's market at the moment, you need to be really, really quick in putting an offer in, and understanding what the motivation is for that particular seller. Is it price? Is it some people might want a longer settlement, so forming the right conditions and putting the right conditions in the contract to hopefully align with the vendor's expectations is key to winning the properties.
Definitely. I mean, we have a lot of clients trying to buy in Brisbane at the moment, and it's interesting. Like, to find a good property, I would say is like you said, it's difficult at the moment because there just doesn't seem to be a lot of good stock or good listings on the market. But when they are, it's highly competitive. Our clients that have lost out. Things sell in 2, 3, 5 days. We have to we have to have the finance approval ready, because if we don't, so the good thing about, I find, with Brisbane, we can still typically get finance clauses at least for a week, just to make sure there's no valuation issues on the property. But if we've ticked off everything else and it's just the valuation that we're waiting on, then it puts you in a much better position when you're offering as well, because especially when it is this competitive, the difference in having the approval versus not having the approval can make or break the offer that you put on.
Absolutely. As well. Yeah, absolutely. And it's you don't want to waste time, and it's, for us as a business, it's also our brand. We want to work alongside selling agents, and we want to make the transaction for them and their vendors as easy as possible, so that we that starts to generate market opportunities, because they know how we operate, and they know when we present an offer that our client is in a position to move forward with that. So you're spot on. It's really, really critical.
What would you say to people at the moment that are wondering if it's a good time to purchase? There's a lot of, I mean, for anyone that lives in Australia, but even for us that are overseas, doom and gloom, cost of living, interest rates going up, everyone's suffering. It's, every other day there's a story about someone that's doing it tough out there. And I notice it when I go back, every kind of month or two now. Things are more expensive than they were
Yeah,
before.
yeah,
You put Australian tax rates over the top of it. It's I wonder sometimes how people make it happen. But I think also for that very reason, every state's been a bit different, but I think for
yeah,
especially like Sydney and Melbourne, obviously they're much weaker markets at the moment. What I'm seeing is, for some of the clients that we have that are not afraid of getting in when everyone else is not, they've managed to pick up some really good deals on some
yeah,
properties, and a lot of them might have future plans. Like it might not be just a pure investment decision for them; it
yeah,
might be something that
yeah,
they want to go back to in 2 to 4 years. But you know,
absolutely.
I guess the bigger, and every market's different in Australia, but I guess the question is, do you think now is a good time to buy versus, say, waiting 6 months?
Uh, Definitely, it's the market is. We just need to look at the growth stats, year on year. Particularly for Brisbane, Adelaide, and Perth, they're the three hottest markets in the country at the moment. Perth leading the charge with significant growth, at 23.6% over the last 12 months, and Adelaide at 15.4, and Brisbane at 15.8. There's some really strong growth trends. And it's not likely to change because for the investors, the stockers, there's not as much stock coming on the market, particularly in Brisbane. It's over the last 12 months, it's 34% down on the number of listings. So as much as there's people sitting in on the sidelines waiting for interest rates to come back to help improve serviceability, recent changes in the government to first homeowners stamp duty concessions going from 5 to 700. That's almost, it starts to bring a little bit more competition for investors who, normally over the 500 mark was a decent playing area. What we're seeing now is that 750 is the new entry point to an investment property.
Yeah,
So it's
6 to
becoming
800
more
is
and
what we
more.
do a lot of pre-approvals on. Yes.
Yeah, yeah, and it just that's that seems to be the number. Anything under that is selling, or you have to go out regionally, and then moving into some regions, it comes with risk. If it's dependent on an industry, it may not be long term, so it might be okay for the next 5-10 years. But if you're not on top of what that region is doing, what the companies are doing in that region, you're risking your investment. So. Yeah, very, very, very challenging. Jumping now is the short answer to that, Tim. Because I think in 12 months' time, what's the opportunity cost that has been lost to waiting? Whether it be saving. People have this propensity to want to avoid LMI as an example, and just come up with a 20% deposit. Whereas a small percentage, if you've only got a 15% deposit, your LMI cost that you amortize over the mortgage for the period of the loan is going to be inconsequential to the capital growth you'll achieve by being in the market today. So, we have a saying in CapitalVue, which is unfortunately not one that we coined, but it's not timing the market, it's time in the market. And that, my own personal journey over 20 years absolutely capitulates and demonstrates that for me. So it is the time in the market. The longer that you have in the market, the better your investment is going to perform if you've bought in the right area. So it's not just any asset. There's a lot of data to be analysed before picking the right place.
Well, they always say, when was the best time to purchase? 20 years ago. When's the next best time to purchase? Now. Before the next 20 years. Yeah. So I think if you look at long-term growth drivers in Australia and why Australia has done so well in property, it's really because of long-term immigration, right? Our population is increasing every year. All those people have to be housed. We've had a real lack of supply. It's only getting more exacerbated because of the lack of construction and the lack of new buildings being built.
Right.
Obviously, the construction sector has had a lot of challenges since COVID. But even now, like those pressures, we're still allowing people to move to Australia, and Australia needs migration. So, but we still have to be able to house those people as well.
Correct.
And until it's going to take a long time, I think, for the curve to balance out, because there's just not enough development happening at the moment.
No, there's not. Yeah, and with the rate of immigration, it's I don't see that for changing in the next 5 years. I think it's going to be a constant pressure on the housing market to house new people. And I think there's also going to be a shift into, the most cost-effective way to house people is in units. So that's, it's also they're also slightly more affordable than houses. So people might start to look to that. And over time, I think people have suggested that units may not be a good investment because you don't have the same capital growth. And while that is largely true, there are also some, if you buy the right unit, designed, developed by the right developer and builder, you actually can achieve sensational growth. And one of our assets again is by one of the more premium builders in a unit building, and we're at 60% capital growth in 4 years. So
yeah, well.
Yeah. So it's not all units are the same, and like any investment that we look for, what is unique about this particular property. That helps it to stand out against the others in the same area, because that's where your value is going to be derived from.
For sure. And the reason units have not done well from a capital growth perspective is because there was a huge amount of construction before COVID, right? There was new towers, Brisbane, Sydney, Melbourne. There was the one market that had an oversupply in housing, but even that has started to equal out now, and probably for the first time in a while, even some of those units are starting to appreciate as well. And the reality is, when housing supply is getting as restricted as it is, there will be no choice for some first home buyers to move into those properties. It's I'd be keen to get your thoughts on, especially being up in Brisbane in Queensland. Are you also seeing a lot of interstate demographic shift? So people moving up from Sydney, Melbourne that a bit older, retired, want to be somewhere warmer, obviously want to escape some of things like taxes in Melbourne. Obviously, Sydney's livability has been really impacted by just how expensive it's getting now.
Definitely. A lot of the competition that I'm encountering when I'm inspecting properties for our investors is owner-occupiers in Sydney. I've got FaceTime calls with other buyers agents who specialise in the owner-occupied space, and it's just that constant demand for good properties to buy. And I think it's interesting in the space we're in. Sydney's always it's awash with buyers agents. It's a very competitive city, whereas it's a little bit more blue ocean and greenfield in Queensland. Although that there's more and more popping up, and everyone's trying to find their own little piece of the action. But there's definitely a huge influx of investors coming in here. So, and when they're downsizing from, yes, yeah. It's a combination of the two, and if they're downsizing from Sydney property because of the price differences, they're able to they pay that emotional tax, as I call it, which we were sort of chatting about earlier on in the conversation. So and that's really challenging, because as an investment, it needs to stack up from a numbers perspective, and if you're buying it to live in, it is your home, so it doesn't really matter. If you pay another $100,000 and you've just sold on a $1.6 or $1.7 million property, and you've sold a property for a couple of million that you lived in, and you're moving up, it doesn't matter. It's a little bit less money in the savings account post transaction.
For sure, especially if you're going to hold it for 10, 15, 20 years as well. It's the price of entry at the time.
That's it. Yeah. And I think gone are the days of trying to find a property where you can buy it under market value. We definitely find that you meet the market or be prepared to pay slightly over the market to secure a property, because the market is so competitive at the moment. I saw some stats. I think there's about 1.2 buyers per property listed in Queensland. So it is competitive.
I'm keen to spend a bit of time, Brad, just talking about, obviously, you really specialize in as property as an investment, right? And really looking at it as, an investment play. And so I'd be keen to learn a bit more about your investing ethos. If you're researching areas, researching suburbs, trying to pinpoint areas that have good growth potential, in the long term, what are the things you look for when you look at these properties or these areas?
Population growth is definitely a key driver. Understanding the median income that exists per household in that particular suburb. and what that's done over time. You want to see, a nice upward trend of, if there's areas or regions that have high unemployment, that sits significantly higher than the current averages. There is a risk attached to that. You're making a recommendation to a client to buy into a place where potentially they're going to have problems with tenant payments. We can avoid that because of the data that we have. So, making sure that those demographic metrics align with what we accept as within a tolerance, to ensure that when we make the play, that we know that based on the historical upward trends and the forward-looking data, we know that what we've seen historically is likely to continue going forward. And property is a long-term game, so you have to take that long-term view and look at what's it going to be in 2025, 2030, and beyond. So,
what is some of the tools or like data points that people can look at if they're doing some of their own research at home? Obviously, CoreLogic RP data people can sign up to and get data from that. But are there other things like, is it easy to get things like council plans or future development plans? Are they easily available online?
Absolutely,
for people?
yeah.
What are some of the things they can be looking for?
Yeah. But if you jump onto Google, you can, depending on the town or the city that you're looking in, you'll be able to come. Brisbane Council will have a detailed list of plans. There's also plenty of data aggregators who actually sell that information if you wanted, to pay a fee to obtain that. Companies like BCI is one example of that. Jumping on realestate.com domain, you can see a lot of these real estate majors have some really insightful data which is available to anyone. You can jump on, have a look, and have a look at suburb data if you're unfamiliar with the territory. So there is plenty of information available to people who are interested and want to just educate themselves and find that out. And as a business, we certainly welcome any people who want some information to reach out to us. We can tap into the information houses that we have to be able to obviously provide that insight and help for them.
It's a lot of reading, so I know a lot of people are time poor as well, which is why, it's so great to have people like you that can help. I do this for a living, and even for me, trying to do all that research myself is a lot. So
and it is very, very time consuming. It's one of the despite having all the data you can have, and the great thing is we can quickly get to the suburb, but then you've got to trawl through the listings, and each you need a lot of DD on each property to see if it stacks and meets the investor's brief before you can even go and have a look at a property. So there's a lot of work that goes in, and it is hours and hours and hours. So it's, to make an informed investment decision, if you're doing it on your own, you're probably 12 months or 18 months away. And in that time, the opportunity cost for it's if the market's moved. So, people look at the fees and think, it's really expensive, but it's, when you look at your own time value, and it's always a great way, and always encourage people, look at your hourly rate that your company pays you, and then if you assign that same dollar value to the time, how long is it going to take you to do that at your hourly rate? And it's a different perspective, and it opens people's eyes to potentially valuing their time a bit differently, and so I'd rather do this, spend some time with my family and my kids, if that's what they're all on the golf course, whatever floats about in the gym, there is a trade-off for that time. So,
and I always tell my clients, if they're a good buyer's agent, yes, there's going to be a fee, but in the long term, they will make that money back for you tenfold if it's a good investment. So just knowing where to go, where to buy, and what are the fundamentals to look for.
Definitely.
I'm keen to also, I've got a couple of clients that have different views on what they want from investment. Some of them are happy to take a lower yield, but really bank on capital gains in the future. Some of them really just want to have good cash flow, good, not stress too much about making repayments on the loan each month, because obviously with interest rates being where they are now, it's almost impossible to positively gear something unless you're putting a 40 or 50% deposit down.
Correct.
So, in terms of what you think is more worthwhile long term, high yield versus high capital growth, or a balance between the two, where do you think is the best people for a long-term investment perspective to bank on?
Yeah, it probably, I'll start by just framing it highly subjective to the person and where they are at in the investment journey. If it is their first investment, and again, subjective to their personal income, how much are they earning, how much surplus or free cash do they have to be able to prop up the investment. Our strategy would always be capital growth first, because that's where you're really going to make your money, and you can leverage that. But serviceability is important as well. So how you set the if you just starting your journey, how you set and what vehicles you buy properties in is really important, and it's probably the biggest learning that I wish I had when I started my investment property journey. So I had owner occupied in 2004 and first investment property in 2008, and I wish that I had someone in my corner who could have shared, hey, if you put it into a trust, you can actually you can recycle your own personal serviceability. As long as the trust, the property's washing its face in that entity, you'll get an accountant to sign off that's the case, and the banks will exclude that from a servicing perspective. So it enables you to scale well beyond your personal means. So I
There's
think
a whole
that's
podcast in that, Brad. So it's
isn't there just yeah.
It's always a bit. It's in Australia. It's a no-brainer. It's
Yeah.
always very tricky for us up overseas. Sorry, because
Yeah.
the lending rules around trusts and companies and entities are a bit more difficult, especially because you're overseas. You need another party to be the resident director in Australia.
Yeah.
So where I see it done well is if someone has a sibling normally, someone that's kind of on equal footing with them, and they want to do things together, that's where it can play out. But where some of my clients really struggle is if they're both husband and wife or partners overseas, and they want to do it through a trust, but they've got no one in Australia that can help them or be involved with it, then it gets murky. Typically they need a guarantee from all the directors, right? And it's let's say some family members are more engaged in that process than others.
Yeah. So. Absolutely. And I think if you're a really high income earner, having properties in your own name, long-term capital growth is probably advantageous from a taxation perspective, because you do get the negative gearing, and you're able to tip in, and the blue chip assets, when you have really high capital growth, it's those markets which, if you're growing 8% on a couple of $1 million versus 8% on 600, you're making an entire above average wage through the capital growth. So the strategies are quite unique, I think, to the individual.
Each person, 100%.
Each person, but if we can encourage, and sometimes it's a blend. If people want to go, it might be buying a unit first that, in one of the buildings that I was speaking to, where the developer and the builders are higher end, they've got great amenities. There's a number of features which help that particular building to stand out. Or it's a boutique building. There's something that's really small, only a few number of units, so low strata, low body corporate fees, those sorts of things. You can still have some pretty good capital growth. You're buying those sorts of assets in areas where there's housing prices are, the barrier to entry is really, really high. We're talking a couple of $1 million, but people still want to live in the suburb. Units or townhouses are really great entry points into those markets. So, looking at those strategies, and then say, right, well, how can we then scale and move towards buying the next asset, which has a better capital growth. So having that balanced approach at the start, and then moving into an asset which is likely to generate higher returns over the longer term.
For sure. And I think, look, property is one of those things that's very easy to say sometimes. It's an emotional thing. But I find even for, investment property should be unemotional, but I think Australians just have such a love of property as well. The biggest, especially when you're an early investor and you're buying your first one or two, when you're looking at some of these properties, it's very easy to go, would I live here? do I like this? Like, is this, is this comfortable? I don't like this, paint, wallpaper, bathroom, whatever, but it's got to remember that you're not the one that's going to be living in it. So if
That's
it's makes sense on paper, if it's got good growth
yeah.
potential, just because you wouldn't live in it doesn't mean someone else won't live in it.
That's exactly right, and and it's such such an important conversation we have with our clients, because it is something that we have encountered. Well, I wouldn't live there. It doesn't matter. You don't have to. There is always someone who is going to live there. And I can lean on my first investment property when I walk through. I said to my investment partner, "There's no chance that we're going to buy this. So, it's a dive." And the response that came back at twice the rate was just have a look at the numbers, and it was positively geared from the get-go because it was a dual occupancy, and so it just made sense from an investment purpose. And that property has continued to do well, and that 40 and 15 years ago the area wasn't it was a derelict area, and it's now an up-and-coming suburb, because as people move out of the city centres and the population grows, it starts to those rundown suburbs start to have a bit more capital investment, and they start to become the new flavour. So if it's that time in the market that we were talking about earlier. And property is a long-term game. It's not like shares where you can have the peaks and troughs on a daily basis. Yes, there might be the market movements, but it is long-term, and shifting the focus as an investment vehicle with property and ensuring that people understand it is long-term. It's really important.
It's I think property is a long-term game. Do you know what I mean?
Yeah.
So it's not something that you make money in 1 year. It takes 5, 10
No.
years. But good investors invest for potential. I think good investors, they don't look at today and look at the hotspot. They go, okay, if I look at trends, if I look at, like you said, demographics and population is probably the biggest one. In 5 to 10 years, where do I think everyone's going to be? That's where the biggest kind of opportunity to do well, especially on a capital appreciation perspective, is key.
Absolutely right. Yeah.
Maybe just a bit more about for you personally. Obviously, you've been buying property for a while. We've got some guests in the background.
Yes. Yep.
We've got, you've been doing this for a while. Obviously, you bought your first property 20 years ago.
Yeah.
What are a couple of the investments that have done really well for you, and why have they done well? And maybe start with this one first. I always say start with the negative, finish with the positive. What were the ones that have not done well, and what lessons did you learn from them? And then what were the ones that did do well, and why did they do well?
Caveat here, I haven't actually sold any of the investment properties yet. So they're all they have all performed reasonably well. And I think early doors, it was the first one was with an investment partner. So having two brains assessing it rather than one.
Where was it, or where is it? Sorry,
it's in Adelaide, in a suburb called Athol Park. And it was a numbers thing, so it just stacked up, and it was slow at the time. Interest rates were double digits, so we had some really high interest rates, and it still made sense. But it was a cheap property, and obviously at a very different time. The pricing back then is very different to what it is now. So there is, it's that time in the market. And then again, next one after that, Glenelg North. So it's a really a great suburb. There's a lot of people who want to live there. So when you purchase in that area, it's again, you're going to have that capital growth. You have that desire for people. You're always going to have tenants. There's always properties that or has rented really quickly. One of our other properties in South Brisbane. Apartment, and again, it's the yield on that is absolutely phenomenal. It's nearly 8%, and it's it's only a one bedder, so it's not it's not a super duper apartment, but it washes its face, and that's been really key. And I guess maybe the learning from there, it as capital growth, it's only probably in the last 12 months that we've started to see some positive impact. But that's when you buy off the plan. It's potentially something which which does play into that. And you look at a lot of the apartment builds that that's how they are sold. And if you're going to make that play, get in early is the advice.
When did you purchase that one?
2018.
Okay. Yeah.
Yeah.
Biggest lesson
I think,
that you learned from picking properties?
You touched on it earlier. Don't get involved from an emotional perspective. Look at the numbers. Property investment, it is a numbers game. When you're buying shares, an example, you don't necessarily go through the board of directors. And if you an institutional investor, that stuff is really important. But as a mum and dad investor, it's not important. What you do is look at the numbers and then make your decision based on largely the historical performance, what the dividend payments, etc. It's not too dissimilar in property, except property is a much longer game. So it's looking at the fundamentals. How the suburbs performed historically, what are the growth rates like, and then you're able to make an informed decision based on the data.
I just want to say thanks very much for today, Brad. It's been really great to chat to you. For anyone that wants to find you, just your website.
Definitely our website, just www.capitalvue, and it's vue.com.au. And we've got our teams up there. You can certainly reach out. Contact information's on the website.
Or they can reach out to me and I'll connect you. So
yeah, perfect.
Thanks so much, Brad. Appreciate it.
Thanks, Tim. Been great. Talk soon.